Want to get paid to buy blue chip stock like Google at a discount? In this video, I'm going to walk you through selling puts and covered calls and how you can use this strategy to generate consistent options income without chasing meme stocks or stuff like that. Now, in this video, you're going to learn what it means to sell a put on a blue chip stock like Google, how to choose strike prices, how to choose expiration dates for income and safety, how much capital you really need to sell a cash secured put, and how much capital you need to sell a put using margin. What happens if you get assigned, and how do you prepare for it? Imagine getting paid today for simply agreeing to buy Google at a discount if the price goes down. Crazy, right? No penny stocks, no gambling on earnings, just using options to collect cash up front on blue chip stocks that you'd be happy to own. In this video, I'm going to show you exactly how to sell puts on Google step by step. So if you want to turn blue chip stocks into a weekly income machine, stay tuned. Now, before we jump right in, do me a favor, please. Please do me a favor. Hit the subscribe button on the bottom right. I'm putting up a video every day for 1,000 days, talking all about options, helping you become a better trader and create income for yourself. Let's start with why I love to sell puts on quality stocks, blue chip stocks, just like Google. When you sell a put, you're basically saying this: I'm willing to buy 100 shares of this stock at this price before this date, but I want to get paid to make that promise. So instead of placing a limit order to just buy the shares at a lower price and get nothing while you wait, you could sell a put and collect premium for the commitment. Now, you could do this on risky small cap names, or you can do it on super strong blue chip names like Google, because they have high liquidity, they have real businesses, real profits, and I'm genuinely happy to own them if I had to own them long term. So if I'm gonna promise to buy 100 shares of something, I want it to be a business that I'm comfortable owning in a downturn, instead of some fly-by-night company that could just go to zero tomorrow. So now let's talk about what it looks like to sell a cash secured put on Google. I'm gonna keep the numbers super simple, and then we're gonna look at a live example. Step one, decide how much you want to own the stock for. So Google's trading around $322 per share. Maybe you'd be excited to own it at like a 5 or 10% discount from where it's trading right now. So let's say that'd be about $290 per share. Step two, choose the expiration date. A lot of traders like shorter expiration dates. Me personally, I'm typically using weekly contracts. Number three, check the premium and the capital that you need to make the trade. So if you're selling a $290 put, you're committing to buy 100 shares at $290 if the price drops below $290 before the contract expires. If it doesn't drop, you don't buy the shares, but either way, you keep the premium. Now, you have to know your two main outcomes. Number one, the stock stays above your strike price. That means the put will expire worthless, you keep the entire premium, and you don't get assigned any shares. Or number two, the stock closes below, you get assigned the shares, your cost basis on those shares gets adjusted, reduced by the premium that you received on the short put, and now you own 100 shares of Google. So you turn right around and sell a covered call against those shares. Okay, let's go through an example setting up a trade on Google. So number one, pick an expiration. Let's pick a contract 2 weeks out. Number two, pick a strike price. So I'm gonna pick close to like a 30 delta. I'm gonna choose a strike price of 307.50. Now this last traded at 244 bucks. So 244 bucks gets dropped into your account, and you're committing to buy 100 shares at 307.50, but only if Google drops below that price before the contract expires on December 19th. Now, I usually check a couple things before I put the trade in. First, I check the rate of return. So let's check that. 244 bucks divided by 30,750 if we have to put up all the money and we're not using margin. So that's 0.007, but that's for 2 weeks, right? So we're gonna multiply that by 26 to get our annualized rate of return. So we're making about 20% on our money. Not that bad. And to blue chip stock, that's super conservative. Now, a couple of other things that I check is, when is next earnings for Google? Because I wanna know, am I gonna put a trade in and then earnings is in a couple days and there's a lot of volatility? I wanna know that ahead of time. So I'm just gonna Google, get that? You get that joke? That's clever, right? I'm gonna Google earnings. So according to Google, see what I did there again? The next Google earnings is gonna be on February 3rd, so we don't have to worry about that. Okay, now let's just check it real quick. How much, if we were using margin, how much we have to put up to make the trade. So the easiest way to do that is we're just gonna analyze the trade in our broker-dealer platform. So I'm gonna right-click on the trade, and I'm going to click Analyze the Trade. And in order for us to sell the 307.50 put, instead of needing $30,750, if it's a cash secured put, if you're putting up all the money, if you're using margin, you only have to put up about $5,900. And the reason why, kind of a small fraction of what would be required if you had to put up all the capital, is because the broker dealer knows that the trade is not as risky compared with another small chip or a little bit more aggressive of a stock. Now I want to walk through one other thing with you. I want to walk through selling a covered call, because covered calls are so amazing. What a covered call does is you're committing to sell your shares if it goes higher than your strike price. You get to choose the strike price. Typically me, I always choose a price just a little bit higher than what I bought the shares for, because I don't really care about the stock price appreciation. I just want to make income off of selling the option. So I take in income again, and I'm committing to sell my shares if the price goes higher than how much I paid for the shares before the contract expires. If it doesn't go higher, I keep my shares, I keep the income, and I do the same thing next week. I'm just creating cash over and over again on the same 100 shares. Pretty cool, right? And how much do you need to do this? Well, it depends on how much you buy the shares for. So you can buy the shares right now, let's say 100 shares when the market opens, and you pay right now, based on Friday's close, about $315. So that's $31,500. If you're not using margin, or if you are using margin, well, we can analyze the trade and see what the margin requirement would be. And it looks like the margin requirement on 100 shares of Google would be about $9,500. So we could also do it like that. And then we turn right around and sell a 315 or a 317.50 call. Now let's say we stick with the same 2-week contract. If we look at a 317.50 call that expires on December 19th, that last traded at $445. So check it, $445 gets dropped into your account. You keep that money no matter what happens. If Google is 317.50 or higher before the contract expires on December 19th, you're gonna sell your shares at 317.50. If it's not higher than 317.50, you keep your shares, you keep the cash, and then you sell another call next week. I'm telling you, selling covered call is super, super conservative. Anyway, I hope this info helps. If you like this video, smash the like button and subscribe. I'm posting new options video every single day to help you create consistent income for yourself, selling puts and covered calls on quality stock, just like Google here. And you don't want to miss out. Make sure you turn on notifications so YouTube lets you know when I go live. In my live streams, I'm walking through real trades in a real account, so you can see everything in real time. The setups, the fills, the winners, and the losers, all of it. Thanks for watching, and happy trading.